Nilesh Shah, MD and CEO at Envision Capital, kind enough to join us today on the show. Nilesh, thanks so much for taking the time out and being with us. Something not quite up your alley maybe, but if I can ask you, what are your thoughts on ETFs? The Bharat 22 ETF garnered a lot of response and SBI runs arguably one of the largest ETFs as well, and they're slowly picking up steam.
Oh, absolutely. I think clearly ETFs will somewhere down the line become honestly a mainstay asset class by itself. And I think will be a fantastic way to participate. And I think the kind of ETFs that we've seen in India are kind of pretty much topical. I mean, by and large, dominated by PSUs. It serves both ends. It helps the government to raise resources, but at the same time, it gives opportunity to retail investors to participate as well. And PSUs are on a transformational journey. Investors have seen the kind of wealth creation which has happened with, say, OMCs in the past or some of the other PSUs. And then, of course, going forward, there are huge opportunities for transforming PSUs and making them more capital efficient. And I think ETFs would be a fantastic way to kind of provide that opportunity to retail investors. And I think they're embracing this opportunity with both their hands.
Well, right now when markets are looking expensive, do you really find some value in PSU stocks? Are you increasing your allocation in any of the PSUs, not necessarily part of this ETF actually?
So, well, we've been so far staying away from PSUs by and large over the last many years. We, of course, own one PSU stock, which is Engineers India, where, it's honestly an engineering company. It's a consulting company. There are no challenges of capital allocation. And all of that, and it kind of enjoys a quasi-monopoly, so to say. And the fact that you're going to see OMCs generating these cash flows, and they will have to expand both brownfield, greenfield, and that in a way provides a captive opportunity for Engineers India to basically, grow its business. The balance sheet is fantastic. It's capital efficient, enjoys high margins. So to that extent, and it's honestly an exception, but otherwise, we've really not been investing in PSUs because obviously you really need to take a call in terms of how policy direction is going to be and those kind of things.
Do you have any thoughts? I know I'm pushing you in a spot out here, Nilesh, but any thoughts on this Bharat 22 ETF individually as well, purely from a perspective of a retail investor who's put in his hard-earned money because he's heard a lot of noise around it and the subscription was so robust as well? I know I'm asking you a difficult question, but any thoughts here at all?
No, I think it should be good, provided, of course, you have to keep in mind that you need to kind of like equities in general right now and the way markets have moved up and the way valuations are. You necessarily have to take that medium to long-term view. I mean, I don't think, you could treat this as one more kind of a listing gain like any other IPO. I mean, if it comes by a way, great. But that's not something you should be really betting on. That's not something you should be counting upon. You will need to necessarily take a 3 to 5 year horizon and say that, okay, over the next 3 to 5 years, if the government really continues on the path of structural reforms and in a way makes PSUs more efficient, then it's quite possible that this basket could at least deliver you market returns over a 3 to 5 year horizon.
Market returns are not outperforming returns?
There could be outperformance as well. Of course, it depends upon the mix of the ETFs and things of that kind, because you have to keep in mind that a lot of these ETFs would be around PSU banks, they would be around OMCs and all of that. And there is a lot of variability and volatility in terms of their earnings and in their outlook. So I'd say that at least over the next 3 to 5 years, they could deliver you market returns. If really the government goes even more aggressive, especially if it gets re-elected and in the second term, if it gets more aggressive in terms of bringing about structural reforms in the way PSUs are run and managed, then of course, who knows? I mean, they could provide you not just market returns, but even market beating returns.
Maybe one last question on ETF. In India, actually, if you have to recommend ETFs to an investor, probably we don't really have enough ETFs to choose from. We have a gold and Nifty and then these PSUs, that's it.
Yes, and I think in a way as an instrument, it's really not yet taken off. And that's because active fund managers, active portfolio managers have been going about and picking stocks and generating the alpha. And several funds and several portfolios have been able to kind of march ahead of, say, market benchmarks and provide better returns. But I think obviously, as markets mature and all of that, ETF will become an interesting instrument to participate in equities. But so far, so that is one. Two is, I think the equity cult in India is relatively new. I mean, by and large, what we see is whenever there's a raging bull market, the interest in equities comes. The moment the bull market takes a backseat, the interest in equity just really goes down. So far in India, investors have been switching from one asset class to the other. I mean, when yields were higher, by and large, investors were into, high yield instruments, then move into real estate, then move into gold, then move into equities. That's the way it has really been so far. Asset allocation is yet to come in vogue. And I think when we see India's financial markets evolve and mature, you will see broad-based participation in different asset classes, and then within equities you would find ETFs also finding its way as a way of taking equity exposure. So the way SIPs got introduced maybe 15 years back, 20 years back, but have now gained momentum, it's quite possible over the next 5-10 years you will see also ETFs kind of come up and becoming a very, very interesting instrument to kind of participate in equities.
Okay, let's take a look at some things that are moving around. IGL has a big gain in today's session. It's up about 4.5%. And maybe not without reason, these companies, the kind of growth numbers that people are talking about for all of these pockets is fairly high. Now, the only question, Nilesh, and I don't know how closely you've looked at this pocket, but the only question is whether these companies have, scratching the surface would be a wrong term, but have they kind of deep dived to the fullest extent already, or is the scope large enough for an IGL, MGL, with the pet coke ban brings Petronet and some of the others also fully into the focus as well? Is there more scope for business expansion? How well they do is depends upon an individual company. Yes. Or is there scope for the market to be large enough for these companies to have meaningful growth over the next 4 or 5 years?
Clearly, I think the scope is large. And clearly, over the very long term, India will transition into a more gas-based economy versus the other fuels. And so to that extent, clearly, gas will remain a very interesting theme going forward. But we need to keep in mind that I think the distribution utilities at this level are fairly valued. I mean, clearly, of course, will they have volume growth? Will they be able to add more number of customers? Yes, they will be able to do so. But I think that number will be more of a high single-digit number. I don't think the volume growth for these kind of the distribution utilities, the last mile utilities, I don't think the growth for them in terms of the volume numbers is going to be more than 10% or so. Over the last few years, they've really been enjoying high margins because they were continuously supplied gas at a lower price, and they basically managed to retain a lot of those margins. So somehow there has really been no lever where they have been forced to cut down the price at which they sell to the retail customer or to the household, because of which they've been able to retain high margins.
You think that can change?
I think it ought to change. I mean, if you're capping prices of drugs and medicines, then that also should be done. You also see basically whenever prices of, say, cement go up, for example, you suddenly see voices coming in saying, cement prices are going through the roof and therefore it should be capped. So I think that's an important risk which is there. Versus that, I think the opportunity in the gas transmission space, I think is relatively better. That's kind of almost a monopoly business. And I think we evaluating, for example, GAIL, which is the sole play if I were to look at gas transmission. Obviously, its stock has had a good run. But I think on market corrections, and if the stock were to correct by, say, 10-15%, that actually could be a very good long-term opportunity because it still does not operate on full capacity. It still operates probably just around that 50% capacity. So imagine, you could double your volume with, not significant capex. That would basically make it even more capital efficient. Your capital efficiency ratios would look amazing. So I think that on a relative basis, say over the next 3 to 5 years, I think we would probably be in the camp to bet on gas transmission play versus the last mile gas distribution plays.
Nilesh Shah is talking large caps. That's interesting, Nilesh.
Well, we talk value, we talk opportunity.
That's true.
Since we're talking oil and gas, do you think Friday's meeting in Vienna can really trigger a big move in equities on either side?
I don't know really about whether it can trigger a big move on equities in the either side. But I think what honestly is what it calls for right now, I think, is some consolidation in global equities, some consolidation in Indian equities, given where valuations have been. 2017 has been a terrific year for equity as an asset class across the board. And I think it's good if we step into 2018 with some kind of consolidation, so that we lay again the foundation for 2018 to be again a great year.
So you are. Would it be fair to assume that you are bracing yourself for some bit of course correction? If not in December, then over the course of the next 3-4 months?
This 5-7% correction, if it were to happen, I think it would kind of be a bit healthy. I think that would set the stage for, again, a decent up move in 2018 as well.
You would presume valuations demand this correction as well?
One is valuations, and I think it will leave some cushion. So, for example, we are pretty optimistic on earnings growth going forward. Earnings growth have been in a way elusive to Indian equities. I mean, we've seen earnings growth of between 5 to 8% for many, many years. It's been a single-digit earnings growth era, so to say. But we believe that with the start of 2018, we believe earnings growth will get into double digits. It may not be the high teens, but it could still be the low teens, or the lower end of double-digit kind of earnings growth. So we believe that's the probability of that is very, very high. And I think if that, along with a bit of a correction in the marketplace, I think could set the stage for 2018 again to be a fantastic year for equities.
And when it happens, which sectors will you be looking at?
I think across the board, but our sense is that it's going to be more around the domestic economy. We still believe that sectors to do connected with infrastructure, so sectors like engineering, cement, these are going to be the big opportunities. I don't think we can remain growing at 6% at the GDP level for too long. India will get onto a path of 7 to 8% growth rate. If that happens, we believe core sectors will do well. We believe areas like public investment in infrastructure, private capex, housing, these are some of the sectors which we believe will start picking up in a significant manner going forward. And if that were to be the case, then a lot of subsectors like cement, some of the fast-moving industrial consumables, these are some of the areas which will start to do well. Apart from that, of course, engineering and services will also do relatively well. So we think some of these kind of sectors will do reasonably well.
Great. Nilesh, I would have asked you about a couple of other micro things as well, but we'll leave that for another day. For today, thank you so much for taking the time out and being with us on the show today.